Welcome to our SaaS Valuations webinar 2025. We're
Hello.
very honored to have you here. I am Marcin Majewski and I'm joined with Philip,
Hi.
associate at Aventis Advisors. And we're very honored to welcome you to our webinar. It's the first webinar we're organizing. So we welcome your feedback after the event is concluded. And we're also learning about what you guys are interested. So during the webinar, please add your questions to the Q&A. We will walk you through the material that we've prepared, but we will leave some time at the end to answer any questions that may have arisen over the course of the webinar. So, Philip, I'll let you introduce yourself and say a few words about what we have prepared for today.
Yeah, so my name is Filip Drozdo. I'm associate at Aventis Advisors, working here for more than 5 years now on transactions across software, IT services, and many others, and also driving a lot of research that we do on our website on SaaS, software, IT services. So very glad to see everyone here. When we started, I think more than 2.5 years ago, we never thought it's going to be so big. And when we first ran our article on software valuations, it got popular, and now a lot of people use our stuff for research or for taking decisions. So we're very pleased with that. And here we are, 2.5 years after running our first webinar, and it couldn't be a better time to do this. When we
Yeah.
first announced it a month ago, we didn't know what's gonna happen, and there has been some changes on the markets for sure. So a lot to talk about, and happy to jump into that. We'll talk about where valuations stand now, what we think is gonna happen, what's gonna happen with the US, European valuations. And yeah, feel free to add your questions throughout the webinar and Q&A function, and we'll try to answer some of them at the end. So let's
Maybe a
jump.
few words about how we got here and why we're doing this. Uh, we always, my ambition as founder of Aventis was to guide our clients to make the best possible deal. And that does not mean the best possible deal in current circumstances here and now, but to look at the whole macro environment and their business trajectory and their also individual career paths, and take all this knowledge into account in order to take the best decision for themselves when it comes to M&A. And sometimes it means waiting with a deal, sometimes it means accelerating, sometimes it means changing the strategy a little bit. So we started crunching a lot of data for our clients, and then we thought, okay, this is relevant to others, so we started writing about it and making it available online, and that's how a lot of you came across the stuff that we post, and sometimes on LinkedIn, on our website, and as this evolves and we have more stuff to share and more relevant, we decided to host this event. And yeah, as Philip said, it couldn't be a better time to talk about valuations when there's so much going on. So Phil, jump straight to it.
Yep. Okay, so SaaS Valuations 2025, where are we headed? So Marcin, where are we now and where are we headed? Let's start here.
Yes, this is one of our favorite charts, which shows 10 years of SaaS valuations, and in a few views. So it's EV revenue multiple for the largest US SaaS companies, EV revenue multiples for a global sample of more than 100 SaaS companies, and EV revenue multiple for private M&A deals. I think we're all familiar with what's been happening up to COVID. So the most exciting and interesting thing is what we have seen over the last year or so with first the boom in valuations following the US election and then a rapid decline. And this is reflected in obviously in global, in the US valuations. This is reflected in global valuation, but to a lesser extent, and this is an important point I'd like to make, we will elaborate on that. We cannot tell how this will be reflected in private M&A deals, but I have a feeling this will also impact valuations quite a lot, given that what we've seen in Q1 2025 is that fewer deals have been closed, and we expect this trend to continue. So the big question mark is, should we make a bullish case now? Is this the bottom? Are we going to bounce back from here given the 10 years history? Or are we going to see more declines? And there are a lot of things going for the SaaS market, and there are plenty of reasons to make a bullish case. There's still low penetration of software and SaaS, and there's a huge need of automation, and the shrinking labor force needs more software to accomplish the same things with less work. So you could argue that it's unjustified that SaaS valuations have dropped. However, there are a lot of things that point in the opposite direction. Would you take over, Philip, from here?
I mean, if I had to make a bearish case for multiples, I'd have to go to, the fundamentals and basics of valuation to say that, look, it's what's important for company value is growth rate, profitability, and how we discount it, what interest rates we use. So growth rates have been slowing down so far. If we have this recession, which may come or may not come, it may drop even further. So now we were at probably 15% median. If we go down to 10, and with profitability not improving, then we really have a company which is not very fast growth, not very high profit, and the interest rates in an inflationary environment, if stay high, then there is just no reason that valuations stay so high. So in a bearish case, the revenue growth deteriorates, the margin are not improving. So this 5 times revenue for a company which has, let's say, 10% margin means 50 times EBITDA, which is quite a lot. Yeah, and in a low growth environment, it's just not justified. We actually dive a bit deeper here on the growth rates and how they developed over past 10 years. And we see that there's been a move down over the past 10 years, except for COVID, when it jumped really temporarily just to continue go down. And now it stands the median US big SaaS companies growing 14%. So what we try to do as we analyze this, growth rate is the most important for SaaS companies. We try to create kind of an alternative metric. There is a price to earnings to growth for a lot of stocks, but here we try to see how EV revenue to growth would look like. So kind of what's the unit of growth price, and we see that it's been on the rise since 2019 and jumped a lot in 21. We probably agree that was overextended. Then it came back, and now it's around 40 stable, but at the same time, in 2020, companies were growing at 25% when this metric was at 40. Now they grow at 14%. So I think if this continues and if growth continues to go down, then the multiples have to follow.
So irrespective, I think we can agree that irrespective of what's going on with the world and the global environment, if we see growth rates decelerating, we should expect EV revenue to decelerate. Yes, in line with what we've seen over a large sample of companies who are rewarded in terms of valuation by growth, by virtue of them growing. And there are reasons to believe there will be less growth unless AI really takes off. We will see about that.
Yeah, so next wanted to touch a bit on the global economy and the tariffs and kind of what's the impact for SaaS companies, how to find yourself into this new environment. So Marcin, tell us a bit more about that and the map.
Yes. Yeah, so here you see the map of the world, and obviously the central thing to what's going on is the situation in the US and the new international trade regime that is being implemented. I'm not gonna say anything original when I say that the US has been an importer of goods for many years now. And so we can see that we illustrate here that the flow of goods was in the direction of the US. And obviously the US has been paying for the for the stuff it's been buying with its currency. Now the question is how does this then balance? Because the goods flow to the US, the currency has to there has to be something that done with the currency. It has to be reinvested. So the world, and in particular China, all the countries that had a surplus with the US have been investing heavily in US securities. So there's been a huge recycling of the US dollars into the US economy, which funded the stock market. It did fund the venture capital industry to a large extent. It did fund the US Treasury also. So the whole world funneled money into the US, the surplus from the trading, and then received securities for their basically work and resources that they send to the US. Now, what we are expecting, or what's happening now with the new Trump administration, is the flow of goods to decline to the US. And this is not how it's gonna end. This is not the end of the story. So the flow of money from the US to the rest of the world as a payment for the trade surplus of the world with the US will slow down. I don't think the US will ever stop being a net importer, but definitely the flows will decline. What this will mean for the world is that they will invest less money into the US, and therefore the world will own fewer securities. So there will be less demand for equities, for VC funds, for private equity in the US. Now, this does not affect it to the same extent the rest of the world. So what we are seeing in the US is quite to the contrary of what we've seen in some pockets of European industry, for instance. So the uniqueness of the American SaaS industry it may turn out that it's not that unique actually to the world, and that it was driven by something that is completely unrelated to the SaaS industry, and that is the trade and industrial goods that finance the innovation engine of the US. Now, as the US funnels now resources away from high risk venture investments and into industry, the picture might change. And to illustrate that, we have a very interesting case study in the next slide that tells volumes about this. So,
Yeah,
Philip, would you contrast these two companies?
yeah. I mean, we took a look at two of some of the biggest and famous companies in software, Salesforce and SAP, which are both major companies in the space, but have actually quite similar enterprise value and similar KPIs. So they grow around 10%, have margins around 20%. So similar right now. And we looked at how their multiples developed over the past 10 years. And throughout this whole period, Salesforce has had, up to 100% premium in terms of revenue multiple to SAP. And now, since a couple of years, it started to change and the gap started to close. And actually, recently, late 24, early 25, we actually seen SAP overtaking Salesforce in its revenue multiple. So I think it's a combination of European stocks going up, American stocks going down, but overall we're seeing convergence, and we'll speak a bit more about it later, about how that looks on a bigger sample, but just a good example on how the original SaaS company, one of the pioneers of SaaS, is now traded lower than SAP, which is supposedly quite an old school business.
A legacy business, yeah.
Yeah,
I mean, that is also a testament of the resilience and timelessness of just good software. So we talk and give much praise to SaaS companies, but good on-prem software that has a path to the cloud, uh, it turns out that can be also great value. So, Philip, what would you say? What is a good long-term hold?
I mean, for me, looking at this, I'd say SAP has a bit better fundamentals, and I think in terms of the stickiness, we talk a lot in SaaS about stickiness. I think SAP is a bit better product, and I think is their position on the European market is more stable. I think what we may see in the coming years as companies buying more software from their own region and a bit of a fracturing of the global economy and trying to rely less on exported software, if you may.
I mean, SAP has a great network of local consultants and has a strong foothold in industrial companies, which should benefit, I think, from the changes in supply chain as they get more complex.
True.
Still, I do believe that American companies will find their way, and even if Salesforce might look a bit under the weather right now with this valuation development relative to SAP, I would bet on Salesforce in the long
Okay.
run and the American innovation ecosystem.
So to sum it up, Marcin, kind of what's your outlook for 2025, especially given all the changes on the market?
Yes, Phoebe, this is a lot to unpack. So if you could flip
Yep.
through our points. So, yes, we're going to see stagnant economic growth. I think we can agree on that. As more stress and uncertainty and barriers to trade is introduced into the global economy and globalization reverses, which will translate to slower revenue growth for SaaS companies. So we can expect enterprise clients to be reluctant to invest in SaaS, and we can expect sales cycles to be longer. And how that translates to valuations, obviously negative and quite big impact on valuations, as forecasts of companies will be slashed. We will see a decline in valuations. The next point, and this is much more nuanced, is the fact that we will see, or we are already seeing, sticky inflation in global economy. However, the changes in trade balance between countries will have varying impacts. So as the US introduces more barriers to trade, they will face more resilient inflation phenomena, whereas the rest of the world may expect a decline, actually, in increase of prices of goods, as there is more slack in the economy and just more goods are available, and there is less demand from the US. So we might see, even in countries like China or in some countries in Western Europe, a level of deflation driven by what's happening. And if we see deflation, we will definitely see slashing of interest rates. So ECB, European Central Bank, is definitely going to be more dovish than the Fed, which will translate to lower cost of capital in the Eurozone, for instance. That's why impact of valuation is very nuanced and should be considered on a country-by-country basis. But our concern is that US-based companies will stagnate in terms of valuation, while European companies and Chinese may see an uptick in, or APAC more broadly, will see an uptick in valuations. Yes, a new thing, I mean, related to economic growth is rising unemployment. This has a huge impact on companies that are priced by seat. Fewer employees means fewer seats sold. So this will also translate into lower growth or higher churn rates. And we have seen that net revenue retention is a huge factor in valuation of SaaS companies. And last but not least, global uncertainty is a factor that introduces friction into the financial markets. And friction lowers liquidity and in turn lowers valuation. So probably not the biggest factor. But as deals take longer to close and capital is harder to come by, this will also affect valuation. So all in all, we wish it were different, but the outlook is not so rosy. Is there something, Philip, we can say to make a more upbeat statement?
I mean, I think it's going to be a first recession if it happens that SaaS companies will go through. So we don't know if it's going to be bad or good. The last time when it was a recession and SaaS was already available globally was COVID times, and then it had quite a positive impact. Of course, this is quite a different situation, and people invested a lot in tech. But we'll see how this one will play out. Usually, looking at this kind of theoretical analysis, it seems there will be quite an impact, and tech is usually considered cyclical stock, so impacted more. But I think it's quite likely that, with the rise of AI and improvements in productivity of R&D, that's going to be quite unscathed.
Yes. I mean, like with any recession, and I think this one has been long overdue, and there will be a shakeout. And I think to the companies that have a good product uh, and good product market fit, I think it's a great opportunity to shine and leave the ones that are getting high a lot of capital from VCs to overspend on marketing. I think it gives bootstrap founders in particular an opportunity to compete, outsmart the highly funded competitors, because funding will be harder to come by. And therefore, like organic work, being close to the client, product-led growth companies, I think we'll have their time to shine. And paradoxically, I mean, like with every period of recession and shakeout, there will be winners and losers. And I think it's important to think about how to be among the winners and how to be among and how to avoid the fate of the losers. Which brings us to the next point, I guess, Philip.
Yeah, I think it's good to pick up from here on the growth and profitability dilemma, which is always a dilemma in SaaS companies. We know of rule of 40, so EBITDA margin revenue growth should be more than 40. And a lot of people probably thinking right now in this uncertain environment, should they focus more on profit? Should they focus more on revenue growth? So we
Yeah.
have a bit of analysis here where we started to analyze what's now on the market. Like after this move in the market, is the growth still valuable? So we ran quite a couple of classic scatter plot charts where we plot revenue growth against the revenue multiple and also EBITDA margin against the revenue multiple. So still as before, and I think as many people agree, the revenue growth is more important on the market even now. So 10% increase in revenue growth is 1.6x plus to the revenue multiple, while EBITDA margin does not have such a big effect. So if you have a dilemma where you consider growth versus profitability and it's 1-to-1, so 1 percentage point of growth against 1 percentage point of profitability, I think for now, looking at the market, it's still quite clear that growth is much better. And Marcin, you want to go on with a bit of an example we did, a theoretical one?
Yes, this is an example, and I think a lot of founders, especially in our audience, face this dilemma: how to allocate their cash flow, whether they should reinvest it in their business or whether they should just take dividend. And I think it's become much more important in this turbulent time to make the right call. And so we've run this simulation, and we found ourselves also quite surprised with the outcome. Though to many of you who are investors and who are modeling SaaS businesses, that might be quite obvious. But we've taken a look at 3 companies. One is a low growth, highly profitable companies with 40% margin, 10 million revenue. The other one is a balanced case with low growth and relatively high profit. And the other one is funneling all of its capital into growth. And the question we asked ourselves is which business is better and which has more value. And in line with the thinking of the rule of 40, you can argue that you can always swap profit for growth. This is never that simple, obviously. And some companies, they just have no way of growing because they, for instance, saturated the market, or the market is declining their addressable market. But in any case, if it was possible and if you face this dilemma, it's good to look 10 years ahead and see what the outcome of each strategy is. So if you have a company that does manage to get some growth out and reinvest some of the cash flow into growing its revenue, we simulate here that the end state is a 20% EBITDA margin company, 20% growth. So 40% rule of 40 again, can grow to 24 million in 10 years and 5 million EBITDA. The second case, if they continue as is, so they continue making 20% margin and 20% growth, they grow to 52 million and 10 million EBITDA. And the last, even though not profitable, eventually becomes profitable, the third company. So if they push and front load a lot of the investments and grow, then they can grow to 104 million by the time 10 years are gone, and get some margin out at the end of this period, 20% in this case. So they're all saying 20% margin after this 10-year period. And we asked ourselves, what would the valuation be of this business today, and which is a better buy? Or in other words, what if you are preparing a company for sale? What KPIs you should have in order to get the most money? So here are the results on the right. You will see that the high growth company with a simple, very simple DCF model is worth more than double, almost double what the no growth company is worth. So even though the cash flow is upfront and is considerable, still, and it's a high discount rate because we applied 25%. Growth has tremendous appeal in this business model. So even if it's a tedious and protracted period of low margins, we definitely advocate for running SaaS businesses for high growth, and deferring profit is still the winning strategy, so long as obviously SaaS businesses stay viable and don't get completely disrupted by AI, which is a separate topic that we would probably not want to get into here. So that's the growth versus profitability dilemma in a nutshell.
Yeah, I think it's quite clear in practice, and in theory that still SaaS founders are better off investing in growth, especially if they don't have to give up a lot of profitability. So as long as the unit economics are there, then it's a winning strategy, even in current times. Wanted to touch by the end before wrapping it up on US and non-US SaaS and geography impact on valuation, which for quite a bit of time has been a mantra, and I think quite obvious for anyone that a listing in the US, a headquarters in the US, or just sales in the US are better and more valuable than anywhere in the world. So in line with our previous example in Salesforce and SAP, now for the first time we saw the convergence of median valuations in North America and Europe. It's been a big premium for a long time. quite a big one during the peak of 2021 bubble. But now, after all these changes and after what Marcin discussed about tariffs and change in capital flows, I think it's quite different, and it may stay there, and it may be a bit different. So, for people who are considering IPO in the US or investment destinations, it may not be as obvious as it was before. Marcin, do you agree?
Yeah. I mean, this is quite shocking to me. I'm still trying to wrap my head around it. Mm, but these are the facts, and what has been the mantra that the U.S. companies are valued more highly, it
Mm.
may no longer be true. So, so this is a big shift, and I think it's a big shift also in investment strategies of a lot of people in this call. So I'm very curious how this develops, and to see what's going to happen. I mean, the reaction of central banks will definitely drive valuations in the next few quarters. So we will see what the Fed does and if it pumps more liquidity into the US stock market or in the US securities in general. If that happens, we may see a rebound of US stocks, but obviously we don't know also what Trump is going to do with the tariffs. We will see in 90 days. So if our great participants want to repeat, I think in 90 days or close to 90 from Liberation Day, we can do a recap and and see where we are headed again. So for now, it's a big uncertainty, and I give it. I mean, there is a big chance this is a short blip, and U.S. stocks will come back. But yes, no clue. I don't think anyone knows these days. So a lot of equity strategists have been wrong in the forecast. I wouldn't forecast also. So only time will tell.
So to wrap it up, we have here a couple of points to sum up what we just said. Marcin, if you can just say where we're at, what's going on, just 4 takeaways for the listeners for today.
Yeah, so it's been a time of great uncertainty the last few weeks, and I don't think it will end. We try to navigate what's going on and have timely information, but no one knows, as I mentioned. However, there are a few things that are quite obvious. I mean, looking back, I don't think we're ever gonna see the SaaS valuations, not only of the COVID era, but also of what we have from what we have seen a year ago or so. And on balance, looking at what's happening with the global economy and the global markets, and looking at the history of previous financial crises like 2008 dot-com bubble, I think valuations are still on a very elevated level, very high by historical standards, and I think there is still a lot of room to go lower before we hit the bottom. And I think it might be even from today's level, maybe 40%. No, Philip, I think. I mean, in our discussions, it's usually when we look at Nasdaq or Nasdaq 100, I think we see still 30-40% room for it to decline further.
Yeah, I mean, when we looked at Shiller P, which is a metric of current price to average 10-year earnings, I think it was in like top 5% of observations over the past 100 years. So there's a bad thing that it's still room to go lower, but good things that we're still in good times. So the valuations are quite good by historical standards, or even very good. So
Yes.
it's
So I
it's
think
great to give
I
an
think it's an sorry. I think it's an important point to make, no? That a lot of people might be scared and might be still paralyzed with what's going on. But if you have a good term sheet on the table, and even if there's a drop in valuation, maybe it's better to sell just to be on the safe side, because I think there's definitely more reason to see downside rather than upside. Um, and there are companies, I mean, resilient companies, strong companies, fast-growing companies. They can take time and they can take risk. But I think yes, you shouldn't look back and think, oh, last year was better. Maybe the good times will be back. I don't think that's gonna happen, unfortunately, or not anytime soon. So before valuations bounce back, I think we're in for quite a ride downwards. Yes, tariffs. They're the topic of most conversations in business circles these days. Mm. They're not going away. I mean, what I can tell about this new administration is that it's quite fundamental, and there are a lot of people for whom it's high on their agenda. So mm, I wouldn't delude myself that it's ever going away. And for every business is affected. SaaS, even SaaS businesses, and they're affected in different ways, and everyone should make sense by themselves of how the tariffs will affect them. But on balance, probably not for the better. I can imagine some companies that don't see much impact. Some companies might benefit. But all in all, tariffs will trigger a lot of consequences that are generally negative for the world and obviously SaaS valuation. So the next point you were making, yes, growth. Yes, I cannot repeat growth more enough. It's always worth investing in growth, even in times like this. And I think fortune favors the bold. And in times like this, obviously, unless you're overstretching yourself, but if you have the capacity, I think it's still it's profitable, reasonable to invest in growing your business rather than slowing down and giving in to the unfavorable circumstances. So I cannot emphasize it enough. And last but not least, yes, very interesting fact, and I think this is here to stay. So North American companies, as we have shown, are not longer trading at a premium, unless obviously they're super big. It's that they're playing in a different league. But if you're looking at peers, I don't think there will be going forward. There will be a meaningful, or right now there is a meaningful premium between North American companies and their peers in other parts of the world. So this is a super interesting development. I think still the US has an enviable funding and innovation and education ecosystem, and they will produce a lot of great companies in the near future. But that does not necessarily need to translate into higher valuations that we have seen up to now, really across the board. Philip, anything to add from your end?
No, I mean, I think I agree overall. The first point being the most important one, that if the growth rate will fall and if we are in for a recession, then combining this with point three, that growth is the most important for SaaS valuations, and the valuations can go lower. And if you anticipate this for your company now, maybe the right time to consider selling, maybe. especially given that historically we are at quite high levels for technology companies. I think
Yes.
we can sum up here and get to our Q&A. I've seen already there are a couple of questions about AI, so I think we can discuss this new technology development and how that affects SaaS valuations.
So you go first?
I mean, I see here a question, brief thoughts on how AI will affect SaaS over the next 10 years. I think we had a lot of discussions on that also internally about what's going to happen with all the AI functionality and whether
Yeah.
it's a new revenue stream for SaaS companies or just a commodity and a must-have and a pass-through to OpenAI and eventually NVIDIA, and how that's going to play out. My personal view is that it's going to be a boost for SaaS companies over a couple of years, maybe 1, 2, 3 years, but eventually the price will go down for that add-ons, and you're not going to be able to have a massive margin on this. So we've seen in some companies that you charge $10, $20 for an AI add-on, and it probably costs $2 to operate that. I don't think you're going to be able to have those margin on this. What do you think?
I mean, I think AI will be like utilities today, maybe not in 10 years, but maybe 20 or 50 years. So like electricity or water is just going to be on tap. I think the line between AI companies and SaaS will blur. I mean, there's only going to be one type of company, and that's going to be AI-enabled SaaS, or just we'll find a different name maybe for these companies. But I think we will not be making a distinction really. It's just going to be part and parcel of every piece of software. Now, I think AI has quite a big impact on the replacement value of companies. It's just building the same software is not as expensive as it used to be. So if you had barriers to entry to new players before, because you've invested thousands of hours into building software, I don't think it's going to be that much of a barrier anymore. So I think the relation with the client, understanding their business case, and being active in helping them solve that business case is going to be critical. And I mean, what we are seeing when we think about our business and services business in general is that there might be also a blurring between services business and technology businesses, because services companies may start encroaching on the territory of SaaS businesses, because they do understand the problems of their clients quite well.
Mm-hmm.
Take consultancies, for instance. And as technology becomes more accessible to them, I think they just might build agents that replace software just because they are more flexible and easier to deploy than pre-customized software or non-customizable software. So we're gonna see a lot of change from different angles happening all at once. But we can't predict really what's gonna happen exactly. But I think on valuations, impact will not be very good. I think with the replacement part, it's gonna make a lot of software less valuable as competitors and replacements for software emerge.
You anticipated, I think, one of the questions here we have. You touched a bit on professional services and SaaS. So the question is, does the valuation depend on how much of a SaaS company revenue is actually SaaS? So if you have 100% SaaS, 0 services, or 70% SaaS, 30% services, how do you compare those?
So we used to tell our clients not to develop professional services, not until now, actually. I wouldn't be so confident to make that statement anymore, just because professional services may morph into AI-enabled services with much more leverage to individuals, to the consultants, thanks to AI. So up to now, basically, valuation of professional services were much lower in terms of multiples. But now that we've seen the fall in SaaS valuation multiples from 7.5 to 2.3, they're much closer to what we have seen in professional services, which used to be 1 to 2, 3 maybe times revenue. So yeah, very interesting question, and I think it's worth to build both these days.
I think it's it also shows that the industry is maturing, because when we look at services valuations, they're rather stable for the past 10 years, excluding the increase in 21. It's kind of low revenue growth, stable margin business. And if SaaS matures, and it's going to be there, so I think it's not going to be a question of which part of revenue is services, which is SaaS, but just overall your profitability, growth rates, and how good of a business this is. Historically, SaaS was much higher growth, so that's why it was valued higher. Now, with the recent changes, maybe it's going to be valued similarly.
Yes, that could happen. Yes, yes. I saw a brilliant question in that list about digital tariffs. This is an exciting topic. I don't think it's feasible to implement digital tariffs, just because it's so difficult to trace the movement of digital goods around the world, and in terms of services, and there are ways to deliver them from different parts of the world. However, I think, and I mean, the EU has been toying with this idea a lot, is taxing tech companies. So on their income. So that might happen, but we'll see how the trade war escalates. But I think it's a thing to watch. Probably gonna happen only with the largest. If something happens, gonna be only affecting the largest tech companies. But I think we're gonna see a wave of economic nationalism, and it will also translate to technology companies. So everyone will want to have their sovereign cloud, sovereign military technology. So I think it's going to be a new era, and we might be seeing a different world for hyperscalers in particular, no? That might be roaming the world and selling the same cloud in all countries of the world is not going to be that easy in the near future. And you will have an EU cloud hyperscaler, and I mean, you have now Chinese hyperscaler. So the world might fragment even more than it is fragmented right now.
I think even if implemented, we know of SaaS companies that they run on quite high gross margins. So a lot of them have cloud costs, obviously hyperscalers, AWS, Microsoft, all kinds of subscription, but most of the costs is labor in R&D and labor in sales and marketing. So I think even if they slap or find a way to slap a 20% tariff or 30% tariff on Microsoft Azure, it's not going to be a very big impact for SaaS companies.
That is true. Yes, 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 yes. Yes.
There's a question on the US market and comparison with European market. If European market is just reluctant to drastic changes, both up and down. What's your take, Marcin?
Do investors react less nervously in Europe? No, I don't think so. I think the money flows are quite similar. I think the strategies of businesses in Europe were quite different. Like the whole story about the tortoise and the hare. The US companies were hares and growing fast, burning a lot of money, while the European companies tended to grow more slowly, a bit under the radar. But maybe it proves a winning strategy for a lot of them going forward. And now when low risk, stable growth might be back in vogue, and the hype around the US market is dissipating, then European companies will have their time to shine.
Yeah, I think so as well. I mean, European SaaS, honestly, it's not many companies there. Most of them are still in the US, but I think in terms of valuations, yeah, some SaaS companies are just more leveraged in the US. And if you're running on a deeply negative profits and a change in interest rates, for example, affects you more than a European company.
Yes, 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 yes.
Okay, maybe one last question here is an interesting one and a very good one on any specific sector which is primed for already seen boost from expected change in global trade. So any sectors you see are benefiting from the tariffs?
No, I think military applications of any kind will benefit. There are not many SaaS companies
Mm-hmm.
in this space, but there are some, no, like military procurement businesses, for instance. So anyone who caters to basically the military will stand to benefit from what's going on when you look for sovereign tech. There are also some industries that should be immune to tariffs. A few industries are exempt because of their importance, like pharma and healthcare. No? So,
Yeah.
although still, I mean, the US wants to have their sovereign pharma supply chain. So, but very few will be exempt. Even fewer will benefit. So if these are all the questions, I think we can leave our contact details if someone wants to reach out and talk about their investment plans or their exit strategy in this environment. Feel free to reach out to me or Philip by mail or LinkedIn. The recording from this webinar will be available, so we will be reaching out if you want to revisit or share with someone. Then we would be obliged. And yes, and that's it. Thank you all for joining today. Thank you, Philip and Shahir, for all your hard work.
Thank you.
And also for putting this all together. Also, we encourage everyone to send their feedback if you think this is valuable, if there's something we could improve. If we get overwhelmingly positive feedback, this will definitely give us encouragement to do more of these and provide you with more of similar insights going forward.
Yeah, thanks a lot. Thanks everyone for joining. I think the Q&A gave us quite good understanding of what people are interested in, especially with the effects of AI on SaaS. So we'll try to look into that. And if there are any other topics that you'd like us covered, please feel free to reach out. Thanks everyone for joining.
Thank you very much. Thank you.
Thank you. Thanks. Bye-bye.
Bye-bye.